How are relevant costs used for decision making? I'm glad you came back, and I want to talk about for a few minutes how organizations can determine what information they need, which is relevant, in order to make specific decisions. I do want to mention our last chapter, we talked about CVP, how to use it really for targeting your income, your profit, also determining your benchmark. And we were also able to see what it looked like when we graph our break-even point. That information is quite important, and in fact, is very, very relevant to organizations today. They use this analysis all the time when either deciding to manufacture a new product or to discontinue a product or even a department. That information is quite important. We're going to extend that a little bit with relevant costs. And again, it becomes important to understand what we have to do in order to be able to make these types of decisions. And in our conversation today, we're going to talk about differential analysis. We're going to talk about outsourcing. We're going to talk about a little bit of whether or not we should discontinue a product or a particular department. And again, these are problems, everyday problems, practical problems that organizations are constantly facing. So I would say this chapter is most relevant to every day. And if you think about it in your own life, what type of things you need in order to make a short-term decision, whether it to be financing something, whether it to be how much time I need to spend or save money to acquire something else. We've used these kinds of analysis intuitively in our own private lives. Let's put together some technical language and really truly understand and analyze what we do and why we do it. So information that you need, again, we're talking about managers, we're going to help them gather the data, analyze that data. We have to talk about what we want to achieve. And it could very well be very, very basic as I wanted to have a target profit. How do we go about doing that? And then that's going to be your goals. You have alternatives, which is mostly the biggest thing about having decisions. You have to choose from one to another, and a good analysis is going to compare the two. What course of action works for us? And then once we choose that alternative, we have to actually determine if it's the right choice. So that follow-up is a very important part of it. So when we implement our decision, we got to take a step back, look at it. Did we do it right? What happened? What was the good? What was the bad? And organizations do this also. It's also a very prevalent activity in finance, whether to invest in a company, whether not to invest in a company. And then if you do invest, do benchmarking. Again, relevant costs, relevant data in order to benchmark that organization or that particular investment opportunity to see if we achieved what we had hoped to achieve. So relevant information can have two bits of info characteristics, again, future orientation, and there is a difference among alternatives. Very, very important. And that's going to be our fundamental assumption in this text. So incremental approach, it looks only at the operating income. We don't want to consider anything that is not going to help us make a decision. And we're going to call that irrelevant information. We want to talk about relevant revenues and costs and profits, relevant to that decision, that specific decision that we're trying to make, which is why managerial accounting is so hard for people, because it's not structured like GAAP accounting. It's a set of rules, a set of procedures, doing it a certain way, making it look in a certain way. All of that is all very, very strict and very good because you want to be able to look at different organizations' financial statements and in a systematic way. And that's the best way to do it, having a very structured format and a structured set of rules. But in managerial, we can ignore a lot of things and use only what we think is necessary. And this is another example of that. So short-term decisions can include the pricing, special orders, whether you discontinue a product, whether you continue processing it, or you leave it as is and sell it in that way, in that form, what kind of product mix you need, and outsourcing. Again, what we want to make certain we cover here is just giving you an idea of when a decision needs to be made. You need to gather all of their necessary data and costs, but you only concerned with costs that are, or relevant costs that's going to affect that decision. So we don't want to deal with sunk costs. And again, these are costs that have already been incurred. We are talking a future orientation here, looking at the future. So anything that we pay, any historical costs, we're going to ignore it. Depreciation could be one of those historical costs. So everyday decisions in terms of impacts on people, planet, and profitability. Again, we are definitely considering all of those because they're very, very important and they're absolutely relevant. Everything that the organization does is going to have an impact on its people, whether it be employees, his stockholders, or in fact, the customers. And obviously, we don't ever want to be involved in any activity that's going to destroy our planet. So there's ethical dimension in this. And profitability, clearly we want to make a profit. We don't want to lose money. We want to be able to grow and be successful and sustain our growth. So again, thinking about decisions and gathering the relevant data to make that decision is the essence of this chapter. How do we apply specific approaches to pricing? Again, we want to be able to price our product in such a way that we not only get the target profit, but we also have to consider how much people are willing to buy. And are they willing to pay that much money for my products? Apple phones are another example. With all of the competition with the iPhone, the Chromebook, and all of these different Samsung, the Galaxy, and all of those types of electronic devices, you have to be very sensitive to what your customers are willing to pay. Very sensitive. Are you a price taker? And there are the characteristics noted below. Are you a price setter for a product? And in some cases, really rare cases, some organizations have a product that they actually set the price. For the most part, I would think they're going to be a price taker. But look at the characteristics of those. And it's kind of important to see if you're a price, with your approach to pricing in terms of price setter, you're going to emphasize on cost plus approach. If you're a price taker, you're going to target costing approach. And we're going to look at both of those in just a minute. What is a standard formula using the cost plus pricing? It's going to take the total cost of that profit and you're going to add to it your desired profit. And this could be done most certainly in a unit by unit basis, which most certainly makes sense. You want to say, how much does it cost me per unit? $10. I want to make a $25 profit per unit on my product. So if I add my 10 plus my 25, my cost plus price is going to be 35. And here's an example of what I said. I used a very simple item, but in the end, it's the same thing. We want to be cost plus pricing because we want to make certain that our profit is embedded in the price that we charge to our consumer. And I would say this is probably the most likely approach when you're talking about a very unique product, a product that everybody wants, but very few people are manufacturing that product. And I don't know if I would say on cell phones or cellular devices would apply in this case, but in some cases, different type of software programs could probably apply in this case. You have a unique software and you're the only one that actually manufactures or you program this type of software, you most likely be in a better position to use this approach. And here is another example, and it's also showing you in everyday terms exactly what your cost per price per unit is. Determine what our customers are willing to pay for that product. Well, market analysis will definitely tell you, and this is kind of important when the company is really starting out with a new brand, because you don't really know what people will pay for your product. So they do focus groups, they do test marketing in order to find out. For the most part, the products that we buy every day, they already have sufficient data to make that determination, to be honest with you. When it comes to phones, when it comes to computers, when it comes to software, when it comes to various clothing items, when it comes to makeup products, organizations have more than sufficient data in the market. Whereas a focus group and a test marketing strategy may not necessarily be necessary. It'd be a waste of time because they have enough data to make that determination. But in cases where you don't have the data, it becomes important to find out. Target costing. Again, starting with the market price. What is the revenue at the market price? And again, this is an amount that people are willing to pay for your product. And you can do this obviously by product cost. How much revenue that you're going to sell that product for, what the market is willing to pay for it. And then subtract your desired profit to come up with your total cost. And again, we're targeting the cost. You see the difference in orientation? Neither one are bad, neither one are hard. They're just different perspectives trying to achieve similar goals. We need to make certain that we can target how much we are going to pay for this. So we're going to extract from that information the profit to find out really what we can get back, or how much we need how much money we need to spend to manufacture this product. Now, again, and when you're talking about your target cost, you're talking about, again, how much money did you need in order to make this product commodity? Well, my target cost is 6.5, but I have my current cost at 7 million. So I have to reduce the cost in order to achieve my profit. And this is not something that you're going to see in your set of financial statements. You're never going to see it. You'll just see the output or the end result of a decision like this. And that's really the point of this whole conversation. A lot of this data will never be seen or even discussed at all in a full set of financial statements with accompanying notes. This is all about management and their way of dealing or working with different issues, problems, opportunities. So that's just one set. The other set is whether to accept a special order. Organizations create a product and they sell it. But what if your customer, a big customer, asks for you to manufacture something on a special basis, something one time only? Should you do it? Should you not? Good question. Analysis would be, do you have excess capacity? Again, that's the first question. Do you have excess capacity to fill the order? If you do, will the reduced sales price be high enough to cover the incremental cost? These are things you have to think about, and this is something that you can easily find out just by talking with management and talking with the accountants and saying, how can we consider and should we consider this decision? And if you do decide to accept a special order, you can do some type of analysis, mathematical analysis, to determine what would be the outcome. What would be the outcome of this transaction if we decide to do it? What would it look like? Would we be in a better position? Would we be worse off? If we're going to be worse off, we're not going to do it. And that's really the main point. Should we do it? Should we not do it? If it's going to be advantageous to us, we get the numbers together, as you've seen in the previous slide. We do it. If not, we don't. We do not accept it. So I'm going to go down a little bit. So I went in the wrong direction. Sorry about that. I'm going in the wrong direction. I'm sorry. Should be going in the right direction, and I am not. Pitfalls to consider. Sorry about that. But the main point I have to say is think about, don't compare your special order with your absorption cost. And absorption cost is all going to be on the financial statement purposes, on the GAAP related. And absorption cost considers everything, all costs associated with a product, bringing it to sale to the customer. And managerial, we don't use that. We consider the variable cost. So if you want to discontinue a product, what do you have to think about? What type of things that you need to do in order to make that decision? Well, does the product provide a positive contribution margin? Remember, the contribution margin is going to be the sales price or the revenue minus the variable cost. Okay, so the difference between those two numbers. If it's going to be positive, are there any fixed costs that can be avoided if you continue? And that's very, very important. When you discontinue a product, there are some fixed costs that don't apply, that will go away. And if this discontinue a product will affect sales of other products, would it affect the sale of other products? You need to know that. And what could be due with the free capacity? How are you going to utilize your resources for other types of opportunities? And here is just an example of what it looks like if you decide, if a decision is contemplated on removing a product line, what impact it has. And organizations can look at it. It's very, very simple, and it's very easy to understand. If you have 3 different product lines and you get rid of one of those product lines, what's going to happen to your net operating income overall? And also what's going to happen to your expenses? So again, organizations may need to know that. I mean, you've seen in your own life how many products that you liked and all of a sudden are not being manufactured anymore. One could suspect that a process similar to this that management had to go through to determine if that was the right decision. A lot of times it has to do with bottom line, but not just bottom line. We're changing it. We're thinking this through. It's not to the organization's advantage to continue to produce this product. And using analysis as a screen we've had before gives you an idea of the types of things that organizations think about when they have to make a change like this. Now, again, avoidable costs are going to be costs that will not have to occur if that product line is removed. And again, this is just analysis of fixed costs that will have go away if a product line or a segment of the business was discontinued. Incremental analysis, again, another scenario, just giving you the idea of what happens when a decision is contemplated on discontinuing a product line. Think about other reasons and other considerations. What will managers be thinking about? What happens? And this is just a decision rule kind of question. If the contribution margin from the discontinued product exceeds the fixed cost, you don't want to discontinue it. But if the fixed costs exceed the contribution margin, then you want to get rid of it. I mean, think about what is the reason why we're going to discontinue and what is the impact. And essentially graphing it on a spreadsheet like we've seen before. What's going to happen? If we would discontinue it, what kind of cost would that fixed cost would go away, but what would be the bottom line change in our organization as a result of it? And scenario analysis works. So don't look at your financial statements and make that decision. You have to compare it based on your margin and specifically that organization's segment that they want to discontinue, using relevant information to make a decision. So factors to consider when you're just making a decision on your product mix. Again, what constraint stops us from making it? Which products offer the highest contribution margin? And will we emphasize on one product over another? And again, we're making alternative choices, this over that. So if you can see from this previous example, if you're going to make shirts or jeans, which one brings you the highest contribution margin? See that? 60% versus 20%. And here is the same old computation that we made before. Sales price minus variable cost gives our contribution margin. Then we compute and get our contribution margin ratio, so 60%. So every sale of a shirt, you get a 60% profit on it. Versus on jeans, you only get a 20% profit. That's essentially how we are going to be looking at these particular scenarios. So machines have capacity of time. I would say the constraint would be that, but then you have to say the jeans are going to be more expensive and bring a lesser or a smaller contribution margin. So if you're going to use your time and you have a constraint of how much time you can use on your machines, one would suspect the shirts would get more time because they bring in a higher contribution margin. And this is just simply bringing it into numerical dollars and what the contribution margin would be considering the two different types of products that they want to sell. Obviously, your contribution margin at full capacity without regard to the jeans, you bring in a considerably higher, look at this number here. So again, your contribution margin at full capacity is $360,000 for shirts. Jeans is $480,000. So when you're looking at these decisions, you really want to make common sense decisions. It really is. Does it make sense to us financially to do it? Can you demonstrate it through your analysis if it needs to be done? And if that's being the case, you consider some of the pitfalls. Make certain that your analysis considers those pitfalls, those things, those disadvantages. Again, with this particular chapter, it's all about making decisions and choosing from various alternatives and trying to form some analysis as to what the impact would be if a decision was made one way or the other. Outsourcing, organizations can say, well, we can do the work inside or we can have someone else do it for us. And a lot of organizations see the financial benefits of outsourcing. It needs to be considered as any other decision-making process. How do our variable costs per unit compare to the outsourcing of that unit? Are any fixed costs avoidable? What can we do with any free capacities and what volume do we need? And again, with these examples, which I'm not going to go to too much detail, is giving you a side-by-side view of answering those 3 questions. And a decision needs to be made. So if your incremental costs exceed your incremental costs of outsourcing, you really want to do it. You really want to do it. But if your incremental costs are less, that means you don't spend as much money doing it, then why would you outsource? You have no financial reason to outsource if it's not going to put you in a better position, meaning less cost, meaning more profit. Even if you kept the sales price fixed or constant, and if you decrease your cost, you most certainly will be seeing a higher profit, which would mean more profit or more contribution margin to be applied toward other costs. And this is just another way of looking at how excess capacity could be used for an organization. That's assuming you decide to outsource. Now, here's just some drawbacks of outsourcing, some ideas that you can think about. Concentrate on core competencies, using other companies' expertise, meaning another company can have an expertise, and because of that, they can be more efficient and save more money. Reduce your risk, obviously lower your costs. But when you outsource, you don't have a lot of control, and you have to manage and oversee that process to make sure that they're doing things right. Whether we keep it or process it further. Well, again, as I mentioned before, 3 fundamental questions. How much revenue will we receive if we sell it the way it is? How much money will we receive if we process it a little further? And again, when you process a little further, that means additional costs incurred. Again, considering that. Then also, what extra will we cost to process it? And again, using examples in your textbook and also using some really logical common sense. If we sell it as is, will we be better off? That's really what the bottom line is. Are we better off? So, for example, here, if we sell it as at $250,000, that's going to be our revenues. Process further, we have to consider the revenues and increased revenue, but we have to consider the increased costs. So if we process it further, our net benefit is $312,500 versus our sell as is at $250,000. In this case, on the face of it, it seems processing it further may make it advantageous for us to continue processing it and then selling. I thank you very much for your time. And remember, this chapter really is all about alternatives, making decisions one over the other, and using really a lot of common sense. Is it better for us? And if it is, how can we show that? Thank you very much for your time, and I hope to talk to you later.